Welcome, finance students and analysts, to today's briefing. Today, we're going to deconstruct the invisible machine that is actively pricing the global economy in real time. People always look to the stock market for economic signals, right? But the real power, the true foundational layer of global finance, it operates right beneath the surface. Okay, let's dive into this explainer and take a look at the actual gears of the global financial system.
I used to think if there was reincarnation, I wanted to come back as the president or the pope or a 400 baseball hitter. But now, I want to come back as the bond market. You can intimidate everybody. That's a famous quote from political strategist James Carville, and it perfectly sets the stakes for our analysis today. And honestly, he wasn't exaggerating. As you'll see, the bond market isn't just some boring parking lot for cautious retirement funds. No way. It's this incredibly powerful force that can dictate corporate survival, collapse major banks in literally hours, and even force sitting prime ministers right out of office.
So here's our syllabus for today's briefing. We're going to cover the mechanics of bond pricing, the 10-year Treasury benchmark, duration and interest rate risk, real-world duration casualties, sovereign debt and systemic risk, and then we'll wrap up with some practical portfolio strategy principles.
All right, Section 1, the mechanics of bond pricing.
To truly wrap our heads around systemic risk, we really need to strip away all the Wall Street jargon. At its core, a bond is astonishingly simple. It's an IOU. A government or a corporation needs cash, so they borrow it from investors. In exchange, they promise you a fixed interest payment every year, we call that the coupon, and the return of your initial principal on a specific maturity date. Simple enough, right? But the global scale of these IOUs is absolutely staggering. We're talking $145 trillion. And this brilliantly illustrates how the global bond market is significantly larger than every single stock market on Earth combined. It's essentially the ocean that the rest of the global economy swims in. And yet, the actual mechanics of how it prices risk are widely misunderstood by the general public.
Let's look at the pricing mechanic that trips up so many people. Imagine you buy a $1,000 bond paying a fixed 2%. You get $20 a year. But let's say a year later, interest rates rise, and brand new bonds from that exact same borrower are now paying 5%, or $50 a year. Well, if you try to sell your old bond, you've got a bit of a problem. Your bond is now the financial equivalent of a used iPhone 11. I mean, it still works perfectly, it pays exactly what it promised, but nobody wants to pay full price for it when the newer, better model is paying out $50 right next door. To actually find a buyer, you have to discount the price of your bond pretty heavily, dropping it down into the $700 range just so that fixed $20 payment yields a competitive 5% for whoever's buying it. Which brings us to absolutely the most important mathematical rule in fixed income. Seriously, tattoo this in your mind. When interest rates go up, existing bond prices go down, and vice versa. They basically sit on opposite ends of a mechanical seesaw. This inverse rule is the exact lever driving every single financial disaster and systemic shift we're going to discuss in this explainer.
Okay, moving on to Section 2, the 10-year Treasury benchmark.
Now, what's really interesting about this is that the bond market, not your local bank, dictates consumer borrowing costs. Say a bank is writing a 30-year mortgage, they immediately look at the yield on the 10-year U.S. Treasury. If the Treasury yields 4.5%, the bank essentially asks themselves, well, why lend to a consumer for 30 years when I can lend to the U.S. government, risk-free at 4.5? So they take that Treasury yield and they just add a risk premium, let's say 2%, for the privilege of lending to a regular person who, might lose their job. That sets the mortgage rate at roughly 6.6%. This formula right here shows exactly how the 10-year Treasury yield actively dictates global mortgage rates, corporate debt refinancing, and really just the broader cost of capital everywhere.
And because it acts as the baseline for capital, it's also a vastly superior economic predictor. Normally, lending money for 10 years pays more than lending it for 2. That just makes sense. But when investors get deeply anxious about the near future, they rush into long-term safety, which pushes long yields lower than short yields. We call this an inverted yield curve. It is essentially the economy's check engine light, and it has correctly predicted 9 of the last U.S. recessions since 1955, with only one false alarm back in the 1960s. So yeah, the bond market usually knows trouble is brewing long before the economists do.
Up next, Section 3, Duration and Interest Rate Risk. Let's look at exactly what demolished the traditional 60-40 portfolio. Back in 2022, as the Federal Reserve rapidly hiked rates to fight off inflation, long-dated zero-coupon treasuries lost a staggering 39.2% of their value. Researchers looked back at the historical data and found that this was literally the worst single year on record for these bonds, dating all the way back to 1754. That's before the United States was even a country. The so-called safe sleeve of global portfolios suddenly became the asset class that bled the most. But why?
Well, so the crucial point is understanding the metric behind that bleed, which is duration. For any finance analyst, duration is the primary metric for assessing interest rate risk in any portfolio. It tells you exactly how much a bond or a bond fund is going to drop for every 1-point rise in interest rates. So if you hold a long-term treasury fund with a duration of 17 and interest rates go up by 1 percentage point, boom, your fund loses roughly 17% of its value. It measures your exact exposure to that used iPhone pricing problem we just talked about.
All right, Section 4, Real-World Duration Casualties.
Let's look at 3 major real-world disasters triggered directly by duration risk. First up, Silicon Valley Bank. They parked billions of deposits in long-term bonds with an average duration of about 6 years. When rates spiked in 2022, those safe assets silently lost $15 billion in value. That sparked a bank run, and the whole thing was seized in just 48 hours. Second, over in the UK, when Prime Minister Liz Truss announced unfunded tax cuts, bond yields spiked violently. This detonated leveraged duration strategies inside British pension funds, causing this massive doom loop that forced her resignation in just 45 days. And finally, Austria. They sold a 100-year bond when rates were historically low. As global rates normalized, the massive duration on a century-long bond caused it to lose 75% of its value. 3 totally distinct financial entities, all absolutely crushed by the exact same mechanical rule.
Moving along to Section 5, Sovereign Debt and Systemic Risk.
So the U.S. tab is currently hovering around $39 trillion, but the figure that should really demand a finance student's attention is this. The United States will spend over $1 trillion this year purely on interest payments. That minimum payment on the national credit card now actually exceeds the entire U.S. defense budget. Interest is the second biggest line item in the federal budget right now, and it's being driven by deficits that are nearing 6% of GDP. To put that into perspective, that is a massive structural shift.
And the bond market is really starting to assert its authority over this debt. Take a look at this timeline from early 2025. Following a major tariff announcement, investors heavily dumped treasuries, which caused yields to spike. Within mere days, the administration was forced to pause those tariffs. Think about that. The policy of the world's most powerful government was reversed in under a week, purely by bond traders impartially pricing risk. Shortly after that, Moody's downgraded the U.S. credit rating. With foreign ownership of U.S. debt dropping from over half back in 2008 to around 30% today, the market is simply demanding higher yields to absorb all that supply.
Let's move to Section 6 and see how this builds into practical portfolio strategy principles.
Here are the core strategic principles derived from all of our analysis today. First off, understand the cost of capital. Stop leaving cash in bank accounts earning 0.5% when short-term T-bills are offering significantly higher yields, often with tax advantages. Second, know what you own. Individual bonds that are held to maturity guarantee your principal, whereas bond funds reprice daily, exposing you to the exact kind of duration losses we saw in 2022. Third, you absolutely must actively check duration on fund fact sheets. That is your explicit risk label for interest rate exposure. Fourth, utilize tools like Series I savings bonds to hedge against the hidden risk of inflation. And finally, always monitor the 10-year Treasury yield. It remains your ultimate macroeconomic dashboard for where borrowing costs are heading.
We've seen how the bond market dictates mortgages, collapses over-leveraged banks, and even overrides government policy. It is literally the engine beneath the global economy. You are participating in it every single time you swipe a credit card or contribute to a retirement fund. The mechanics are relentless. The bond market will keep pricing your life either way. The only question is, as a student of finance, can you now read the price tag? Thanks for joining this explainer. Keep analyzing the data, and we'll catch you in the next briefing.